This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com.
Hey, everybody. Welcome back to the Investing with the Whales podcast. My name is Jonah Lupton. I am your host. Today's guest is Ivana from SPRX. So she runs an ETF. And just for disclosure purposes, if you want to know the exact holdings, you can go to her website, which is spir-invest.com. And now that that's out of the way, Ivana, how are you?
I'm doing great. How are you?
Good. So before we jump into the ETF, we can talk about some of your themes and strategies. Just give us a quick little background on yourself.
So sounds great. I've spent over 10 years working for hedge funds on the long short side. So always doing fundamental investing. So it would be firms like Citadel, Millennium, a small tiger fund. And then over time, I built expertise in industrial technology. So I would cover industrial companies, but then figure out where these companies are investing their CapEx and R&D dollars. So I started building a portfolio of my own ideas and money that grew in size to a point where I looked for different options of what to do with it. And I decided to launch an ETF about a year and a half ago.
So a year and a half ago, that was a tough, and I know you have a kind of a growth/alpha strategy. So that was obviously a challenging time to launch an ETF, but I know you have some phenomenal performance year to date. I don't know, I'm probably not allowed to say what the performance is, but people can go to the website and probably look it up, or you could just look up the ticker. Am I allowed to say what the ticker is?
Yeah, you can say.
Okay, so the ticker is, it's SPRX, correct?
Yep, that's correct.
Okay. So now let's talk about what is now this is an actively managed fund, correct?
Yes, that's right. So the fund is actively managed. It's concentrated. It invests in B2B technology, and basically it's based on fundamental research. So what's different about this than other strategies out there is that all the ideas are based on boots on the ground work. So I go and meet with companies, talk to management teams, do surveys, channel checks. So that's really what's behind the ideas. From a high level perspective, I feel like all the funds or all the strategies look very similar. But if you zero in, these are almost different jobs, right? So like whether you get a job working for a long short hedge fund is very different than if you're working for a mutual fund or if you're working for an index fund, right? So like the job itself and the process behind is very different. And where we differentiate ourselves is managing risk while staying fully invested and staying risk on all the time. So what that means is that during downturns, you don't necessarily want to be cutting risk because that would essentially be timing the market, right? So you want to always have risk on, but you do want to manage the downside in specific names or companies or ideas, right? Where you're not really down 70% and you cannot recover from that. So that's really like basically the idea is that you manage risk better on the downside. And then once the market turns, you are full on invested to be able to capture the upside.
So a lot of people are obviously familiar with the big ETFs like SPY, which is the S&P 500, the triple Qs, which is the NASDAQ. And then, of course, you have actively managed ETFs like ARKK, which went up, came back down. You come from the hedge fund world where typically hedge funds can do kind of whatever they want, right? They can go long, they can go short, they can play with options, they have different hedging strategies. What sort of hedging can you do in an ETF?
So depending on what you disclose in your prospectus, you can basically do whatever is disclosed there. Okay. We are long only, and we don't use options. So we are just using basically research as a way to manage risk, if that makes sense. So we can use, like, for example, on earnings, if we don't feel, even if it's a high conviction name, if we don't feel comfortable about it, we can cut the size quite a bit and purchase it back on the aftermarket. So from an investor standpoint, you won't even be able to necessarily see that, right? Because it will just get booked as a gain the following day. But and you'd probably be down a lot, right? Like if the stock went down, but over time, you're really minimizing the downside risk while capturing the upside. So that's how I would describe our risk management strategy. It's basically like the two typical things that people talk about in hedge funds is idea velocity. So we track our idea velocity. If you're not doing well, you want to be picking up your idea velocity. So the more new, fresh ideas you bring in that replace older ideas, the more likely it is that you will do not necessarily well in a tough market, right? But you will outperform in a tough market. And then the other one is basically turnover, which means like cutting, like managing like upside downside, capturing alpha on the upside. So those are like the types of risk management strategies that we do.
It's funny you say idea velocity, because that's sort of where I am right now. A lot of my biggest holdings are up 40, 50, 60% year to date, to the point where now I'm starting to trim them. So, and I got to try to find new ideas to put some of that cash to work. And I'm having a harder time coming up with new ideas right now. So I can appreciate that challenge. Now, when you say bottoms up, what exactly does that mean?
So we have a very thorough process, very similar to what you would do at a hedge fund, basically in terms of research. So every time a new idea comes based on our process, basically of identifying what themes are going to be working, what trends are going to be working, what's cycling up and what's cycling down. Once we narrow down what we want to analyze, we go really deep into that particular stock. And it's not only just building financial models and quantifying the upside downside. The real value comes from talking to customers, talking to suppliers, identifying if there is anything in the financials that could be wrong. Like in the past, we've been able to identify $100 billion of balance sheet liability for 3M, right? And we would go to court hearings. We would basically follow the court cases, how they're developing, and based on that, we would form a fundamental view of a specific stock. So that's really the main difference, I would say, in terms of what a hedge fund does. And we'll put a lot of resources into this research process. Like we'll go wherever the company is to meet with management team. We go to industry conferences. So that's really like the biggest kind of difference in a strategy like ours versus like what a mutual fund would do or what an index fund would do, right?
I mean, especially a big mutual fund. You see these $15, $20 billion funds at Fidelity or Vanguard. Even if they're actively managed, they're basically just an index fund. Like
that's
they're still going to have huge positions in all the large S&P companies, because they don't want to skew too far away from their benchmark, and they also need liquidity to get in and out of these huge positions. Versus a smaller fund, a smaller ETF, you can be much more nimble.
That's right. So yeah, so it's interesting because a lot of people are asking me like, oh, so is this a large cap growth? Are your strategies like large cap growth strategies? And in theory, yes, like I invest in large cap growth stocks, right? But it's very different if you're trying to put together a very diversified portfolio of 100 names that are large cap growth, and then you play with the weightings to beat your index, versus if you're like, okay, I'm going to pick the 3 best semiconductor stocks, and then I'm going to benchmark myself against a passive index, right? So for us, like we need to always, like the few stocks that we pick, it's usually 1, 2, or 3 within a subsector. They need to be outperforming the underlying index. So that's really how we generate alpha. It's the same thing on cybersecurity side, right? Like we want to be picking 2 or 3 companies that will outperform any other cybersecurity index. Of course, it doesn't always outperform, right? That's part of the challenge of the job. But that's basically the goal, is to be selecting 1, 2, or 3 names that will do better than the broader index.
So let's talk about some of the holdings. And once again, if anybody wants to see your exact holdings, sizes, and whatnot, they can go to your website. But I know that Zscaler is one of your top positions, correct?
Yep, that's correct.
So they recently did a pre-announcement, which isn't typically I don't think they typically pre-announce earnings, but the stock had been down. So I guess the timing was great. I think the stocks rallied 30 or 40% off of the lows of the year. So what do you like about Zscaler as a company? And then why is it your favorite pick in cybersecurity?
So basically, the way our picks are usually based on is upside downside to the current compared to the current price. So for every company that we analyze, we'll have like what we think is a downside scenario and what we think is an upside scenario. So that's how the sizing will be. So Zscaler would be a large position just because we see an upside, let's say double versus a downside of 15, 20%. So that's kind of how the sizing works, just more broadly. And particularly, we are very excited about cybersecurity. So I think that's one of the sectors that, because it did well or relatively better last year, stocks were still down 50, 60%, but not 70, 80, right? So that's basically the relative outperformance. They are facing a little bit tougher comps this year. So comps in second half are going to get significantly better for the cybersecurity space in general, and cloud spending is in a similar boat, right? Like it held up relatively better last year compared to semis, which were the first to go into the downturn. So cyber cloud, those are some of our favorite areas going into the second half. And Zscaler in particular is a very unique asset. I don't think a lot of people appreciate the strength of the business and specifically the channel partners that they have built over time. It's basically plays in the enterprise space. So they're like looking to upgrade systems of large enterprises, and they can continue to sell products to these enterprises. So a lot of people talk about competition, and Cloudflare is introducing a new product that is lower cost. It's not that easy to break into this market. So we think they have a pretty strong position here.
Now, was it your largest position before they pre-announced earnings, or because of that move, it became your biggest position?
Because of the move, it became the biggest position.
Okay, so after a stock,
so it was like it would be a large. It was still it's been a large position for us over the past let's say 6, 7 months. But because of the move, it becomes larger, and then you need to decide like what's the upside downside in that specific versus like the next company that you have, and based on that you will decide whether you want to be trimming it or if there is still enough upside you want to be keeping that same size.
So have you trimmed Zscaler since it made that big move off of the pre-announcement?
No.
Okay. But you probably have a price in mind. If it reached that price, you would probably start to trim it.
Yeah, so it's not necessarily a price in mind because it competes for other ideas. But yes, if it outperforms by a lot, basically in theory, the upside for that particular stock will be smaller than for another stock. So going into this year, NVDA was actually our largest position.
Oh, okay.
So basically that company did really well, and we did trim very little bit just because all of these beaten up stocks have a lot more upside versus we still see a lot of upside in NVIDIA, but just not the same level.
It's already had it's already up over 100% off the lows.
That's right. So at some point, companies like NVIDIA were up 100. Shopify is another example that was a large, like one of the top 3 or 4 stocks. It's had a large move. So now will it be up another 100% in the next 6 months, right? So that's really the questions that we're asking ourselves.
Right.
But
I mean, I'm the same sort of manager, active manager, right? I do the same thing you do. What's the potential upside over the next 6 months? What's the downside? And I've been trimming some of my stocks that are up a lot this year and adding to some of the laggards that I think could outperform over the next 6 or 12 months. And you just keep on rotating money around.
Yeah, that's exactly right. So that's and the challenge comes from the fact that I think what a lot of people miss when something outperforms, sometimes it limits the downside as well. So I think people often miss that, like, for example, it's not necessarily like NVIDIA, I'll just give it as an example, right? It's outperformed by like 100%, something like a cloud infrastructure name. But the interesting thing here is that while the upside may be less, now that the story is out and everybody knows about it, every hedge fund manager that I've spoken to wants to add to this, right? So the downside is not necessarily back to like the 120s, right? So like the downside is really a lot lower. So it is pretty attractive still, not because of the double, like the huge upside, but because the downside is more limited, if that makes sense.
I mean, the story's out, the investment thesis now looks a lot clearer. So the stock's been re-rated, at a higher multiple. I mean, some of my stocks, Uber, Mercado Libre, last night, Nubank reported earnings. Nubank is a digital banking company out of Brazil, crushed earnings, net income margins expanding way faster than anyone expected. So that changes the story. It re-rates the stock at a higher multiple. So even if the markets pull back, you don't expect a stock like that to pull back, too much, because you'd expect the buyers to come in and, and bid it back up.
Exactly. So you don't necessarily want to be cutting it, even though now there is, in theory, less upside to your price, right?
Right. Exactly. And those are the stocks that I want to be buying on pullbacks. The fundamentals are strong and getting stronger. What are some of your other favorite stocks right now, your top 10 holding stocks that you've been adding to recently?
So we like the semi space still. Basically, what's happened is that semiconductors are usually very early cycle. This is because of inventory. So inventory in the channel, they don't sell direct to consumer, they sell through the channel. So what ends up happening is the moment you see small downside in demand, it really gets amplified in terms of demand to the semiconductor company. So this is why they were the first to go into the downturn, and they are the first to be coming out. So as we kind of the AI story got out there and people realized, okay, NVIDIA is really the only company that makes these GPUs, we had been looking for other names that can play on the same trend. And AMD is actually quite well positioned here because they are introducing a new GPU that they're going to start producing in the fourth quarter and next year. So there is demand right now for GPUs outstrips available supply. So we believe they're going to be able to capture some share of this market. So AMD was a new position we added in 1Q of this year, and we wrote about it in our investor letter.
Any sectors that you're staying away from right now that you think there's still some more pain to come?
Well, we don't like economically sensitive sectors right now. EVs fall in that category, where we believe there is still more pain to come. And not only that, we believe there is pain to come, I think the recovery, this is one thing that people don't appreciate, the recovery is not going to be as strong as prior recovery. So I think everybody or most investors have started investing in, like most young investors have started investing over the past 10, 15 years, right? And they really have not seen a cycle where you didn't bounce aggressively off the lows. So post-COVID, real aggressive, like hockey stick recovery, right? 08, 09, that was a very aggressive recovery. I think this time around, we didn't really see a very big pullback on the downside. A lot of it was because people already knew about the Fed and they knew about interest rate increases. So you were able to model the impact as you went down during the cycle. But on the flip side, so that's why we think the downside was more muted. On the flip side, we think the recovery is also going to be very muted. So stay away from more economically sensitive areas, not necessarily because there is a lot of downside, but really like where is the upside going to come for places like autos or other like consumer areas.
So outside of, I mean, it sounds like you stick to mostly tech, semiconductors, cloud software, cybersecurity. Any other segments or niches inside of technology that you really like?
Enterprise software is another niche that I think has worked better this year. That's been actually among the outperformance. The outperformers. This is because their business models are a lot more stable in terms of like the SaaS model. So basically, once they saw the interest rate impact, which was pretty meaningful, get reflected in the stock prices, fundamentals are actually not that bad, and they're worse than they would have been if you had a strong growth economy. But they're not really like, they're maybe 500 basis points lower than what you would have expected, but they're still holding up pretty well. And I think one thing that people may not appreciate here is the impact of AI, right? Because a lot of these companies will be the key player in a specific industry. So like HubSpot has like this whole SMB space or a pretty significant share and growing, right? Or like Shopify has a pretty significant share of retail or an entrepreneur, like more of the smaller type retail. So these companies will be able to use a lot of this data and either introduce tools that can add value to their customers, so you would be willing to pay more, or extract value in some other way, basically leveraging their large customer base.
So how do you know when to start a position? I mean, is it all based on valuation, sentiment, your investment models going out 3-4 years? I mean, I know, like, do you get into a stock thinking you're going to hold it for 3 or 4 years? Or, I know you're willing to sell a stock sooner than that if it hits your target, if it goes on a big run, you think it's going to pull back, you don't want to hold it for a pullback. But like, when you get into a stock, like what triggers your initial buy? And then like, what's a typical starter position for you?
So basically the way it works is we have a universe of about 120 names split up into different areas. So semis will be one area, cloud will be another, cyber will be another. So we have 10 other of these that we're right now not even invested in, right? But we will keep doing work just to stay on top of trends that are going on in that industry and see if we can find an inflection in the demand environment or in the underlying fundamentals. So usually the catalyst for starting a position is seeing that something, either comps are getting easier in a particular area, like the consumer got really hard hit last year, so now comps are getting easier. So we're like, okay, well, let's look at some B2B companies that serve consumers. So that's how we ended up with Shopify. And then once we narrow down to like a group of names that we're invested in, we'll do fundamentals, bottoms up research, and do the analysis that I talked about before, where you're like quantifying upside and downside. And once you get to a point where like the downside is more limited, it's still pretty significant because these are like pretty volatile names, but a lot of our stocks will have like 15-20% downside and are doubles from these levels in terms of upside. So what we target to find is companies that can compound at 15-20% rate for the next 5 years. So if they get quicker to this level, then we'll take some profit, right? Like some may double in a period of a year. And then they basically compete for basically upside downside for a spot in our portfolio. So we have a bench of another 10 ideas that are pretty interesting here. They're just not, they don't offer as big upside downside. And a starter position can be directly a 5% position. So it's all about basically how much upside you see. So it doesn't necessarily have to start small. Like we'll build it over a few days based on like what we believe are good prices, but it doesn't necessarily have to start small.
Okay, gotcha. You do anything in fintech?
No.
Nope.
Yeah.
What are your,
No,
what are
we
your-
try to. So basically, I try to really stay to my niche. A lot of times I'll see companies that are very interesting, like Nubank you mentioned. It's a very interesting company, but it's basically it's pretty difficult for us to capture alpha if we're not really in the weeds.
right.
So that's kind of like what I've found in the past. If you are really in the weeds of something, you're really going to be able to manage the downside better because you know the company well. If the management sounds not super comfortable before earnings when you meet with them, or if you go through transcripts from conferences and they've said like things along the lines of we're not comfortable in the short term, but we're confident in the long term, like all of those are kind of red flags. So usually what I've found is that we can manage the risk better if the company is in our like exactly in our niche, and if it's tangential, it's a little harder to do that.
So SBC, stock-based compensation and dilution have been a hot topic for the last year or so, as you've seen some companies in the tech industry continue to give out a lot of stock to their employees. And as the prices have fallen, that can get kind of dilutive. What are your thoughts on SBC? I mean, I know the benefit is it's obviously non-cash. So, if the company is losing money or barely profitable, they're not chewing up their valuable cash with higher salaries. They're complementing salaries with stock, and then it incentivizes the employees because they own a piece of the company, blah, blah, blah. But like, what are your thoughts on SBC? Like, do you think companies need to get more disciplined with it?
Well, I absolutely think that it's a critical part of the comp structure that they're offering, and it has a lot of benefits in terms of during a downturn. You don't have a large cost structure, right? You can be a lot more nimble. But I do think companies are going to be getting a lot more discipline and thinking about it. And I think it's interesting because like what we saw in the past cycle when companies awarded stock comp, they always assumed that price is going to always be going up, right? So it seemed like a very attractive thing to give. Now, when you're giving stock, the employees may not necessarily view it the same way they did in the past cycle. So I think there's going to be even pushback from some of the employees on the stock-based comp, and over time, companies will migrate more to a traditional model. From valuation perspective, as long as you're incorporating it well in your analysis, it really doesn't make a difference. So when I talked about the upside downside, we will take a pretty significant hit for stock-based comp for companies that do have where that's a large percent of the comp structure.
Now, when you're looking at one of these cloud software companies and thinking out 2-3 years, what the valuation might be in 2 or 3 years, are you looking at earnings or are you looking at free cash flow? Like, I feel like that's always the debate with investors is, how do we value these companies like Snowflake, Cloudflare, Zscaler, CrowdStrike? They all have phenomenal, well, Cloudflare not as high, but like Snowflake, Zscaler, CrowdStrike have phenomenal free cash flow margins. They don't, their GAAP EPS numbers obviously don't look great yet, but that will come in time. So like, what do you focus on? Do you focus on non-GAAP, GAAP, free cash flow, or do you try to look at all of it?
Well, we look at all of it, but free cash flow is key, right? That's basically our main input in our valuation. It's a DCF model, right? So as long as you account for all the non-cash items, like we talked about with the stock-based comp, free cash flow is really the key metric that we focus on for the long run, right? So like when we model it out, that's basically the main input in the valuation. In the short run, a lot of the metrics that are important will be very specific, like billings or like how much revenue are you getting from existing customers, right? Versus how many new customers you're gaining. So on a short-term basis, we look at a lot more of these specific data points. which can provide a forward-looking info basically of like where the cash flow trajectory will be going. So you may be expecting a company to have free cash flow, like if they're generating a lot today and that's growing at like, let's say 20% in line with, or 20-30% in line with their revenue growth. But if you're starting to see some of these metrics not really jiving, and especially if you figure out that it's not macro driven, right? Like sometimes when it's macro driven, that's fine because you know that the macro will recover. But if so, for some reason you're not getting new customers, or your current customers are not willing to pay as much, we like all those metrics are really key to pay attention to.
So here's a question, and I hope this makes sense. So you have a background in long short. So if you're doing all of this analysis, you know, bottoms up analysis of all these companies, some of which compete against each other, some are in the same sector, you know, competing for the same clients, you must, like, let's just, you know, you're looking at like 10 cybersecurity companies and you say Zscaler is the best, CrowdStrike second. I'm just making this, you know, I know Zscaler is a top position. I'm not sure what other cybersecurity companies you own, but then you look at, you're like, okay, these 3 or 4 cybersecurity companies are our least favorite. You know, they're losing market share to Zscaler. Do you ever miss like being able to run a long short strategy where you can go long your favorite ideas in the sector and go short your least favorite stocks in the sector?
Yeah, so that's a great question, actually. So in my business plan, I was thinking about building this as a long short strategy initially. The challenge with that is that it's very difficult to comp performance unless it's a market neutral strategy. And then a market neutral strategy, it's not necessarily a great long-term investment, right? So markets go up over time. If you're a long-term investor, there is really no reason for you to be neutral to the market. So that's why I started like, okay, well, what makes sense for me as a long-term investor? Alpha generation on the long side, it's a lot, will drive and compounds, right? That's the other thing that's easier on the long side, that when you do well, you have a bigger capital base to do well off of. On the short side, when you do well, your investments shrink, right? So it's basically like, as a long-term investor, this type of strategy works a lot better than a long short strategy.
Long short really only works in a pullback, a drawdown in the markets.
Yeah, and it works for institutions. Sometimes they want to allocate to something different, and they can maybe, like, if the returns are less risky, they can lever those returns. So that's what a lot of the funds do. So I may consider doing a short only strategy down the road, but I'm not exactly sure what the interest in something like that would be outside of periods where there is right,
like a 2020, like a 2022.
Exactly. And those happen like once every like 15 years. So having a product out there just to bet on those years, it's a little tricky. But yeah, like actually, like my background, and you're spot on. Once you do thorough analysis, you uncover so much shit about these companies. I mean, it's just unbelievable. Like, so when I was on the sell side, what I was able to do is, because I was not investing in the large cap stocks, is I was able to write research about them. So me and my team were basically the first ones to highlight GE several years ago when they had their problems with the accounting of the aerospace segment, when they had this large insurance liability that was not disclosed anywhere. And same with 3M. Basically, a few years ago, we uncovered a gigantic, potentially $100 billion liability for the company that was literally one line in the 10K. So like, once you go through these 10Ks, it's easy to spot like, oh wait, like, why are there now 6 cases of lawsuits versus like last year there were 3, right? So you can spot those and find great short ideas. It's just kind of hard to capitalize on it in the current structure.
So last question I'll ask, if anyone watching this is thinking about starting an ETF, what advice would you give to them?
So that's an interesting question. So I would say first trial the market and fundraise to a critical size if you're not putting your own money, because it's a pretty expensive structure. So really the two routes are, you're either going to commit your capital and the case for the ETF will just be working even just with your own money. That's kind of the case for me. Or you want to partner with somebody that will bring in the capital. So that's really the biggest thing, is the cost structure, right?
Which I think is what, isn't that what ARK invested in the very beginning? I think they actually got seeded by that. Remember the guy from Arca Legos, whatever his name was, that blew up his hedge fund? I think he was their first investor.
I don't know the
really?
story, but that is very.
It's a wild. It's a crazy story. So
yeah,
I'll send you the article.
Not familiar,
but yeah,
that's basically the route. Like, you either get a seed investor, or if you're putting your own capital, then you have a little bit more leeway. But it's really like to cover those base expenses in the beginning. And
what you probably need to get, like seed investor, you probably need to get to what, 3 to 5 million just to start with. I mean, that's not even close to break even, but.
Exactly. Depends on the math you're doing. I think you need something like 20 to break even. So it kind of depends on how much are you willing to cover on your own, right? And like for how long how long can you do it? The fundraising environment is very challenging right now. So it's kind of hard to bet on just being able to get money out there. So that's basically the advice. Like, if you do start with a capital where it's sustainable, I think it's a great way to bring products to. It's a great structure to bring products to market. So there are a lot of benefits to it.
Okay, awesome. Well, Ivana, thank you so much. And once again, your website it's spear-invest.com. Where else can people find you?
I'm on Twitter newly, so nice meeting you there. and I'm on LinkedIn as well.
Okay, awesome. Well, thank you so much for your time. Really appreciate it. And I know you've had some great performance year to date. So best of luck, and I hope it continues.
Thank you.
Bye-bye.